I'm going to be buying gold, and I'm not the only mug that is considering it. The search term gold investment has gone up over 200% since December. I thought, let's just dust out the old Bachelor of Economics and dive into gold investment. I wanted to work out if gold is a type of asset that would protect my portfolio in the case of some bumpy financial markets. This is not financial advice. You need to speak to your professional advisor to see if gold is right for you. As always, by going past this point in the video, you agree to be bound by our terms and conditions in the disclaimer, which has been linked below. First things first is, what is actually gold? Well, gold is a metal and it has become a tradable commodity. But I guess that doesn't answer the question is, why has gold been associated with a store of wealth and value? If you go to information from economic historians, there's still some debate around gold. But what I gathered from reading a lot of this information is that when humans started trading, we were effectively a commodity economy. And what a commodity economy means is we often traded apples directly for oranges. But the problem starts to happen when you start transacting it in larger things. So for example, how would you take a horse to swap for a wheelbarrow full of apples? Around this time when there was direct trade of goods, someone smart thought, well, how about we pick something rare and scarce such as gold, silver or jewels to use instead of the actual commodity as a measure of value. And with this advantage of being able to easily swap a horse for some gold came the disadvantage, which is the fact that gold became a theft risk. This is not the only problem with gold. Also with larger transactions, say a house, how would you exchange a large amount of gold or silver for that? So this is when banks started to be formed, and effectively gold would be safely and securely deposited in a bank, and the bank would produce some form of IOU, such as a bank note. And this is where the gold standard effectively continued on from. The difference between a bank having an IOU for gold and the gold standard was that entire countries' currencies were backed by the amount of gold that they held in their vault. So really, gold is actually just a convention which has been passed down from generations to generations of humans that says that we all believe in gold as a store of value because our forefathers used that to trade in exchange for goods. Moving forward to the current day, I'd say that gold has maintained this convention of being a store of value because of three reasons. Primarily the fact that it is already a scarce commodity that can't be easily produced. The second thing is that it's widely traded, so there's a lot of markets around the world that will accept gold in exchange for currency. And finally, it's a liquid market, meaning that if as one individual you were to dump a lot of gold into the market, this is more than likely not going to impact the price. So this is why it's maintained that convention of being a store of value. Being that gold is a financial product, many industry commentators do suggest that there are some disadvantages. These include the fact that gold does not have a yield. It doesn't generate any form of income for holding it. The second thing is that gold in itself is actually not a really practical material that's widely used. If you were to remove the convention that humans believe it's a store of value and dump the world supply of gold onto the market for its practical uses, there would be an oversupply, and it would take many, many years to be able to use up all the gold that is currently circulating the financial market. The third thing is that gold in itself is volatile. The price moves up and down based on supply and demand factors outside of its control. And finally, there is the fact that there is risk and there is storage requirements of holding gold as an asset. When looking at gold as an investment, there was a range of arguments against it by various financial commentators, but they really boiled down to two key areas. The first being that gold is not necessarily negatively correlated with financial markets, meaning that when financial markets go down, gold doesn't necessarily go up. I don't claim to be a statistician, and I do take on board the academic research, but what I've done is overlaid a graph of the Dow Jones, which is the American stock market, in relation to the gold price. Over the entire time series, I would agree with the academic research, but we're not looking at holding that gold for the entire period. What we are looking at doing is considering a trading position. Now, a trading position of gold or a trading position of any asset is when you plan to exit it after you've speculated on it increasing in price. And you can clearly see at some point when the Dow Jones does drop quite drastically in a financial shock, the gold price does increase. The next thing that a lot of financial commentators stress about with gold is that gold doesn't produce a yield. What that means is that if I was to put money in a bank, I would effectively earn interest. If I was to buy shares with dividends, I would receive those dividends. With gold, this is not the case. So what they suggest is the opportunity cost of investing in gold versus another asset that does produce an income means that you're missing out on that income. Now, while this is technically correct, what I might mention is that I'm not entirely concerned about the yield across two different assets. I'm looking at the appreciation of that asset's value. So my view is if the market is going to go down and I'm going to take a trading position, I'm expecting to sell that trading position for a higher amount, ignoring the factor of yield, and then I'm able to rebuy back into the market, which has gone down, with an increase in capital because my gold investment has gone up in value. This gets me onto my personal investment hypothesis about why I'm buying gold. And there's two reasons for this. Firstly, there is some academic research that does suggest in 83% of times when the stock market goes down, the gold price does actually go up. The second is that gold is a hedge against inflation. But I must stress this is only a personal view, and many industry commentators suggest that there may not be any correlation with the gold price and inflation. So what actually is inflation? Well, the economic definition of inflation is a persistent and appreciable rise in the general level of prices. Well, there's a commonly accepted economic principle that suggests that an increase in the amount of money supply leads to inflation, meaning that if governments around the world continue to print money, this will result in an inflationary environment. So this is why that search term gold investment has probably gone up 200%, because money printing is increasing, so people are thinking, how do I make sure I protect my assets against inflation? I've done a lot of looking into this, and there is no easy way to explain inflation. But what I wanted to talk about is a very simple economic model that I've kind of put together in my own head that justifies my theory around inflation and the gold price. Think about the global economy as a basket of marbles, and those basket of marbles are effectively currencies. For example, you might have a red marble which represents the United States, you might have a blue marble which represents Australia, you've got gold marbles, you've got green marbles which represent other countries. Now at the start of any trade, each marble is on parity, which means that you've got one red marble can be exchanged for one blue marble. Within the world economy, gold is also considered to be a store of value, so you can swap one marble for a bit of gold. Now that gold, again, is on parity, meaning that you have one marble in exchange for one bit of gold. So let's, for example, say that you print twice as many red marbles in the market. Well, the other market participants realize this, and effectively they price in that increase in the amount of marbles in circulation. So just simplistically, if you've doubled the amount of red marbles, you may have effectively halved its value. So instead of getting one red marble to one blue marble, the blue marble may now demand that you have two red marbles to purchase one blue marble. Now, let's think everyone decides, well, heck, red's now printing a lot of marbles, why don't we print marbles as well? Well, effectively, more marbles enter circulation and the relative values of each marble depreciate. But coming back to gold, gold is still a scarce resource that no one can print and no one can make because you've actually got to physically mine it out of the ground. And that is also circulating in this economy. Well, effectively, what has happened is the price or the intrinsic value of gold has stayed the same. All the other currencies have devalued relative to it. Now, remembering, when I hold an investment, I can hold that in Australian dollars or American dollars, and if they're deflating in value, why don't I just put that money into gold, which is not going to deflate in value, and then when it does deflate, I buy back that currency at a cheaper rate. Now, this brings me to my crux of why I'm considering buying gold, because the amount of money printing in the entire economic system is unprecedented, and this is to deleverage the financial markets. So if you believe in this narrative, then how do you actually go out and invest in gold? The first way is buying bullion direct. Now this is a great way if you want to guarantee your own investment, meaning that you physically know you hold the asset. I do stress with this option, you want to get two things right at the start. The first thing is you want to be buying it from a reputable source so that you know it's real gold. And the second thing is you don't want to be paying for ornamental gold coins that are marked up, but they do have some intrinsic value of gold. Effectively, you do want to be buying a tradable bullion which you can sell at a later date for the relative value of how much gold is held. Now, the disadvantage of this particular strategy is that you take on the risk of holding that asset and having to store it. But the advantage is effectively you own it and you know it's there. The second way to invest in gold is through a gold ETF. And this is probably the easiest option as there's a range of gold ETFs listed on the ASX as well as various other stock markets around the world. An ETF is effectively a pool of funds which goes out and buys gold related assets. In theory, the total value of the investment is equal to the net tangible assets held by the ETF, meaning that if the gold price increases, in theory, your investment value increases. Now, being a disadvantage of this particular structure is that you are relying on a third party to buy those gold related assets. And you're also bringing in risk that they don't necessarily buy underlying gold, they might buy derivatives or other things which relate to an appreciation in the gold price. So you are taking on some form of ETF risk. And being a gold bear out there, if you believe that the financial markets are going to fail, it's possible to believe that ETFs are going to fail. But the advantage of this particular strategy is that you are going to be able to trade it just like you would trade a stock. You can just call up your broker or lodge a ticket on your online broking and you can buy and sell at any time. The third way is to go out and buy gold producers. Effectively, you jump on the ASX or other stock markets around the world, find companies that purely mine gold, and then in theory, when the gold price increases, their production profit increases and their relative share price appreciates. It's worthwhile mentioning that coming to one of the points around gold not producing a yield, if you buy a company that produces gold, they might pay a dividend and all of a sudden you've got an investment in gold that is income or yield producing. A lot of people commonly ask, why are gold producers leveraged to the gold price? Meaning that if the gold price goes up 5 to 10%, why would owning a share in a gold producing company increase 10 to 20%? Well, there are actually a range of factors that go into valuing a business, but simplistically, if you look at a gold mine, if they have a fixed cost base for producing the gold and the gold price goes up, all of a sudden their profit margin's gone up. There's a common thing called a multiple, and all of a sudden that multiple is applied to the increase in profit margin, which leads to a greater appreciation of the share price. There are a range of disadvantages with buying a gold producer to get exposure to gold. Firstly, you don't actually own physically any gold, you own a business that produces it. The second thing is that when you buy any business or any stock on the ASX, you take on a lot of other risks such as business and management risk, as well as government risk and financing risk. So these can all impact the value of your shares. And finally, there's a range of factors that impact the valuation of a business and ultimately their share price, which is not necessarily related to the value of what gold is being sold for on the market. As a quick cautionary note that sits within buying a gold producer, you might consider a gold explorer or a junior miner which has not yet got an operating mine. Now, a gold explorer basically goes out and finds land or a tenement that's rich in gold and then flips or sells it on to someone who can develop it into a mine site. The other option is that gold explorer might try and develop the mine site themselves. Now, the success or failure of this operation is often not dictated by the price of gold. There's a whole raft of other factors. And if you are looking at gold as an investment, this is probably not even on your risk profile of what you're going to consider. So I'm not going to go into it any further, but it is an option that people do talk about. The fourth and final strategy is not that common or popular anymore because ETFs have replaced it, but effectively it's a unit trust or a managed investment scheme that buys gold. What basically happens is a third party or manager goes out and buys gold assets. There's a predetermined exit, whether it be a price or a date, and then those assets are sold and the proceeds are paid back to the unit holders, which hopefully you've got some profit from the investment. Now, this is not that common because it doesn't offer a lot of liquidity like an ETF where you can buy and sell it on the ASX or any other world stock market. But I mention this because there is actually one ETF that's a lot closer to unit trust structure, and that is the Perth Mint Gold. That is a bit different to a lot of other ETFs on the market. And what that is effectively a ETF that you can buy and sell on the ASX, but also you have the option as an investor to turn up at the Perth Mint and collect your investment in physical gold. The other thing which is different about this ETF is it's actually backed by the West Australian state government. So it's not owned by a private enterprise, and you can physically claim the gold that it holds. This is not an investment recommendation, it's just a quirky thing that I've picked up when looking at a whole raft of alternative gold investments. So now you kind of know what gold is, you know what commentators suggest are the advantages and disadvantages around gold. You have an idea as to why that search term, gold investment's gone up over 200%, and you kind of know how to invest in gold if you want to do it. So if you've liked this video, make sure you subscribe to my channel, and best of luck with any investment that you consider.